my war beard.
Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we've got Karim with us from Northstarbadcharts.com. And we're going to talk about, I guess we're going to start with differing opinions on potentially different opinions, but different ways to look at some charts, perhaps look at Bitcoin, Ethereum, compare it to other bottoms, those types of things. And maybe we have a little bit different ideas. Maybe we don't. We'll see. And we'll debate back and forth so you guys can make decisions possibly on how you would approach an investment. And I think we maybe have a little bit different approaches, which is good because it's going to be, I think, quite entertaining. I'm just throwing out ideas.
Well, man. Well, you'll see where I'm coming from there. It's kind of violent, but it's like it's funny because that was a running theme there on my Twitter recently. I'm trying to explain to people that buying the bottom does not mean I could buy higher than the bottom. I could wait for some confirmation. I could make as much money as you that you bought at the exact bottom. It's all about position size. It's about risk management. It depends how you do it, because a lot of noob traders, what they do is they get a bottom, they have 100K in their NAV, their tradable asset. I'm buying 100K of whatever, Bitcoin went down 30%, it's going up. And then they think that's how professional traders do it. No, it's not how you do it. That's horrible risk money management. You cannot do it that way if you want to survive, because they're putting 100% of their NAV in one trade, trying to catch a bottom. And if it goes up, it's twofold. They've developed the worst habit ever. Even if they managed by a miracle to pull that off, they've developed the worst habit that they're going to blow up their account because they're going to try it again because they think that's how it works. Well, I'll show you by sharing my screen. I'd rather buy higher out of a big base, have a solid stop where I know it's controlled, where I have a strong base, like a breakout line. It now becomes support. I have a higher swing low. I could put a sell stop there. And then I can manage my position size and have some measured moves. But catching a bottom, it makes no sense to me at all. It's like, it makes no sense.
Can we see your approach? If you can share your screen, show us kind of what you mean by your approach, given a chart.
Yeah, I could do a few examples. So let's say,
yeah, because I think I do a different approach, and we can maybe describe those approaches.
Let's say Franco, Nevada, or we could do Bitcoin. Let's say Franco, Nevada. Let's say Franco, Nevada is going down, and I'm right here. Okay, this is the monthly candle. I'll put maybe more granularity, maybe the weekly. Reset chart, remove indicators, remove drawings. Okay, so let's say Franco, Nevada is going down. It's all the way down here, and I think that's the bottom, right? It's breaking out. So I decide to buy here on this candle here, right here. So this is TradingView's risk management tool. So you buy right here on this candle here. Where's your sell stop here? So let's say you buy on this candle here. The sell stop has to be below the previous candle low. Like, where would you put your sell stop? Let's say you're wrong. You have to knit some time. Let's say the price action would have went down. The price action I could have bought here in this candle. The price action could have went there. Like, it could have, right? It's like nothing. Where's your sell stop? So I'm going to just put the line here where I bought it. The sell stop, I'll put it thin. I entered here. Sell stop, I'm going to put it here below the previous swing low. If I look, it even back tested it here. So it gives credence that these descending trend lines, they're very aggressive, right? A falling wedge, the implied measure move of a falling wedge is the top of it, but it doesn't always go in one shot. Like, yes, FNV has been going nuts, but there's a high chance that this thing does not reach the implied measure move, which will be the top here in one shot. It's probably going to go here, stop. It's probably going to stop here at this wall, and then it's probably going to go down, create a higher low, and then after that, then it has a chance to go in its measure move. But so I entered here, my sell stop, in case you see it went down low, you don't want to get triggered out. So it has to be at least below the previous low of that wick. So that's my risk here. The target, where's your target? Your target is It could be here. You could have it here if you want to get greedy, but usually the first, okay, I'll get greedy. I'll say the target is going to go all the way up to previous high because that's a measured move. You cannot have a higher target than that at this point for Franco, Nevada. You could say, oh, but Patrick, look, there's a measured move from this entire base. I'll add it on top. That's not the target yet, this target up here. That's you getting greedy because this is a massive wall right here. So right now, you got to respect the chart trading. You have a descending bearish, bullish wedge, and its applied measured move is at best, it's this line here, which is also previous highs, etc. But I would make a case that this would probably be the most logical target. If you're lucky, you get a wick, but this is a wall. So previous support and resistance, it could be that one, but I'll put this one. So I'll double click on the long position tool. So let's say I have 100K NAV. I'm going to risk, usually you won't want to risk more than 1% of your NAV on any single trade. And here it calculates everything. Here's my percentage. So my entry is, I'm entering at 165. My profit is at 212 and my stop level is at 150. So that gives me a risk to reward of 3.22 to 1. So I'm case one. You still hear me? My mic, I think it did something.
It went in and out. Yep. I can hear you.
So I'm risking one. So let's say for 100K NAV, that risk, it'll be $1,000. So if ever this trade falters, I will lose only $1,000 because here I will buy only 68 shares of Franco Nevada at $165. That's how much I'm going to buy to get in. And if ever it goes to my measured move, I'll make 3 times as much. So my ending NAV will be 103,217. You see, if I go all the way down here, my NAV will be 99,000. So that's somebody trying to catch a falling knife, a bearish falling wedge. You could say, and look, I could have put the moving averages here, but it's probably still below the moving averages. Says maybe there's a range here. I'm playing that. I could do the same thing now. A 3 to 1 risk reward ratio is not that bad, but I could actually wait and buy on the breakout above this line here. See this line here? I don't know how the chart's going to look like here. So let's say it goes up here. It fluctuates a little bit here. Say it goes here eventually. I could be patient, be the cheetah, buy here on just above on the monthly close above this huge box. The sell stop, I'm not sure quite where I'm going to put it now, right? It could be a little lower, below the swing low here, but it's going to be tight because this is going to be critical support, just as it was critical resistance. And now my measured move is this move here, this huge box. So that's my measured move target. Look at my risk to reward, Andy, 4.9. I have a better risk to reward waiting for that huge pattern to complete than trying to play catching that falling knife, which is not, this is not a pure falling knife. It's not bad. It's breaking out. There's a wedge. There's like, you're playing a channel, but people don't understand this. So I'm buying, how many percentage higher? I'm buying much higher. So here, instead of buying here, I'm going to buy 29% higher. And I'm be making more money than you will trying to play that counter trend rally or trying to play that, just because I'll be able to have a bigger position size right here, or a further target, a better measure move target all the way up here.
Well, I guess what I'm saying is I bought Franco Nevada in 2016 and haven't sold it.
Ah, yeah. Well, that's okay. That's you're not trading there.
Well, no, that's what I mean by just like buying it when you've got a buy signal and then you just hold on. You don't actually try to play it. But from a big picture view, that just looks like a big consolidation pattern that's about to break to the upside at some point.
It's beautiful. I was about to do a chart and I was about to do a chart today and I was staring at this and I said, holy Moses, is Franco Nevada something special? Do they pay dividend, this company?
They do. Yeah. It's not huge, but they do. It's a good company.
We have a lot of members and stuff that but Patrick, I need a big cap stock. Well, look, Franco Nevada is not I don't know. It doesn't, but it's not like a gold stock in the sense that it should have been going down during these years.
Well, it's a royalty company. So it gets royalties from a variety of different things like gold, silver. I think it even has oil and maybe even like copper and other base metals.
It's super bullish here. Look, it's doing practically the same thing it did back in 2018. Oh yeah, that's what I was telling Kevin. It's doing like a false breakdown below 3-year moving average above the cloud. I'm telling
Yeah.
you,
So this thing's just my approach, I know it's a little bit different, is I try buying on those trend lines on the bottom. I know it seems like it's weird, and then just riding it higher. Because I think that fundamentally Franco Nevada is in an uptrend on a long-term big picture view, like you've just done there. And I just say, you know what, buy it and hold it and just ride the thing, because you've got gold that's cheap to the base monetary supply. Gold's cheap to the S&P 500. Gold's cheap to everything. So,
well, you want the price action to confirm to you. Look, when I'm talking, look, Franco Nevada, honestly, this is the beauty of TA. If you're patient and you wait for these coiling patterns, the market's doing the hard work for you. So it's creating a situation where even if you wait a few months, and this thing goes a little bit sideways for a few months in that thing, you'll be getting you'll be reducing opportunity cost, because until it breaks out of this thing, it could go like this, right? But I could probably be buying just a little bit higher, practically just a little bit higher than you did here. But if I wait for the breakout right here, right above this line here, man, it's like no opportunity cost, because this thing is gonna rocket ship as soon as it closes above that line. This is what's gonna happen to Franco Nevada. So it could happen this month, next month, the month after. It could happen, but it could start in 2024. This move, like, I don't know. It could start in you see here. This is 2023. Do I want to put in my, like, I could probably get in if I could wait a little bit, wait for the price action to confirm. I could have that cash on the side and just wait, and I won't be buying that much higher than you did on this. Well, maybe a little bit, 28% we said, right? Depends where. Yeah, I'd say I'll be buying 17% higher, but I'll be reducing opportunity cost.
but
Look at these moves once it broke out. Look at this here. Look at this candle here when it broke out. You didn't have to wait anymore. It's like it was, because I'm telling you one thing, until the price action confirms, any goddamn thing could happen. Yes, this thing you could have bought here, but it could have done that also. Like the president could have ran away with his girlfriend. It could have been a Brie X. I know it's not that, but like this, until you close above these lines, this is a possibility. This was a possibility here until the market closing above a breakout line. It's the market telling you, okay, look, the coast is clear for a while. Good. Thank you. We're going to land in the 7 hours and the destination. So I rather wait a little bit, buy it here. There's no, like, I don't know. I just don't want to give away the control that I have, because I don't have much control as a trader, but I do have the cash before I enter the markets, because I've been trapped. I've tried. Sometimes I had bad timing, and then you're there a month, 2 months, and then goes down, and then it drains on your emotional capital, and then you're all locked up. And the more it goes down, you see this with what's that stock there? AAG there. I was looking at that stock, Aftermath.
I just bought a bunch of that.
Well, now it's not that bad, but look, if anybody that would have tried to buy that thought that it was some type of bottom here, look all the months that went by. This could have happened to Franco Nevada. I didn't, but this could have happened. So now what's happening to AAG, it's breaking out of that first line that I showed you. So now at least you have a fighting chance of having a rally that's going to try to go back to, so here's my target. It's going to be in between here and here. So that's my target. So yes, now AAG it's telling you it's having a chance, but what could really happen, here's a 3-year moving average. It could easily do this, do that, and then do that. So
I agree.
Until I could just wait, I could do this, accumulate, but I'm below a 3-year moving average. It's a tough road. A lot of people got trapped here that bought in 2021, silver squeeze, all that. A lot of people are going to want to break even and tell their wife, I didn't lose any money on my silver trade, honey. They're going to want to break even. So all the indicators are going to be super stretched by the time we get up here. So it'll be super stretched indicators. This thing's going to want a breather. So I'd rather wait until, look at this beautiful pattern there. Look at this thing. If that thing breaks out, look at this thing. This is massive.
Yeah. It's a massive fractal. Definitely. That's a double bottom pattern.
Yes.
Is what I've seen in it. Yep.
But you will have the bragging rights. I won't have them though, Andy.
So what I do is I line up the fractals of other bottoming patterns, and then I try buying that bottom of the pattern as far as I can get down on it. And
Yeah,
that's
like
just, and I spread it across. I allocate a certain percentage to the portfolio. Now, I agree with your approach in terms of risk. I'm entering at a riskier time, but my rewards will be multiples of anyone else. Multiples.
no, wrong. That's not true. There'll only be a multiple if you wager irresponsibly and you put in a huge amount. Because I could make as much money as you buying on the breakout higher than you will. The only way you'll make more is if you buy low, but you don't sell where you're supposed to sell. You decide to hang on. But if you use classical charting, like I showed you for FNV, if you buy now FNV, your target's not the same target that I have on the breakout. Your target is the neckline. The logical target is the neckline I showed for FNV there. I'll go back. That's the difference.
That's if you're trading it. Yeah, I'm holding for
you're going to hold
entire
it.
market condition, I should say.
But
I have a different strategy.
Yeah, we can't do that as like on our website. We can't do that. It's if we want to survive long term, is we have to do it. Yeah, this was another example I did for FNV there, but we have to do it that way. And a lot of people, they get upset at us. Somebody got upset at Kevin, one of our members. He said, "How come you're not long Newmont? How come you're not like?" They must be listening to your channel. But
no, I don't. It's not Newmont.
Look,
it's
look. If somebody has the itch and wants to get in, fine, you could get in here. But the risk to reward, your target will be the neckline. It's not the same target. It's not this target here. Let's say you get in here where you did. The target, the logical target is here. You should be taking profits here. Let the dust settle, wait for a pullback. And then after that, on the next bounce, you could try maybe to get in again. Yeah. But essentially, so yes,
your strategy is more of a trading strategy. Mine's more like I'm trying to buy it for the entire duration of a bull market, which you're going to go through pullbacks and ups and downs and stuff like that. It's a little bit more, there is a little bit more emotional toll to pay, so to speak, when I hold for longer periods of time.
Because look at here, everybody loaded up here, right? But look what happened for 2 years. It was tough for the people, even everybody that caught, this is the gold versus SPX. Let's say you got in early on gold, and you even hear, and when it broke out, and then in 2020, look at the pain you had to go through. There was a lot of unhappy people there at this stage. Oh, Patrick, like a lot of people sold at the bottom here. Unfortunately, it's sad, but a lot of people they gave up here. You remember it wasn't pretty here. Like a lot of people saying gold sucks, and they have for 2 years. Patrick, you were wrong, and all that there. This is what happened here. That's possible. Like right now, we were definitely early and back in 2020, definitely early, because in hindsight, when I look at the gold to SPX chart, gold was breaking out of that huge base in June. It was beautiful. Like, but if I had a better view on the gold versus SPX ratio, and if market in the miners until gold breaks out versus SPX, it just doesn't happen. I would have had to hold my breath and say, look, we're not out of the cloud. It's trying, but look what happened. It just faltered after that reverse. Look, it hit this wall here, a few wicks. So for me, I'm going to go full on crazy bullish gold and silver miners once gold gets above half the value of SPX. So around whatever SPX is, well, let's say SPX, it melts up, it's at 4,000. Well, if gold's 2,000 when SPX is 4,000, like when gold gets here, I'm going to get super, super bullish. And if it gets above this line here, we're going to be just like here. Because you look, the bull market in US didn't start in the miners until this happened for gold, until it went up. And then in 2003, actually, I could overlay a silver chart. I think silver, XAG USD. Silver actually started blowing up after gold got out of its, look at that. Here's silver.
ratio.
Even if gold's
Mhm.
outperforming SPX, that's just the first leg. But silver actually went ballistic once gold got out of the cloud and really started getting bullish. And I could even go back to the 70s, and it's the same thing again. You need gold to outperform. And then when gold outperforms, see when gold breaks out here on this line right here, it outperformed SPX on the breakout. Silver just went ballistic when that happens. So it's like we're so close to the goal line. I'm just afraid. I know the weight of evidence is not there, but there is a small chance that we're in 1994. I hope not. I don't think so. But there is a chance that we're right here, Andy.
If you zoom in on 2015, 18, 20, 21, like that whole area there on the right. Yeah. So we're putting in one gigantic double bottom. You have a lead-in pattern on the left that happened in 2015, 16. Then you've got the bottom in 2019. It retests the peak there. Yep. And then you've got a double bottom, which is coming. And then I think that we're going to go all the way up. We're going to rip it to about that. Yep. Right to that spot. We'll probably sit there for a little while and get caught. I think it's a double bottom, that whole thing. A big double bottom.
Look, I'm telling you something. We're so close, Andy, because all you have to do is wait for one candle to close above this line here, and it's confirmed. The market has told you it's good. Because there is one case, this could happen, a tiny, whatever, I don't know. Like this could happen.
Mm-hmm.
We don't know this arrow, how long it's going to be. We just don't know. It could be. So yeah, it could slide here. But if that slides, the miners are not going to look good. The miners will be pulling back. Silver will not look good if this thing goes back down here. That means the capital flows are going back into those damn growth stocks. And that's all she wrote. That means Bitcoin's going to go up probably, and all that other stuff's going to go up if this goes down.
Mm-hmm. No, I agree.
I agree. Tesla's going to live again, and all these Facebook's going to come back to life.
I think it's possible for like a double top or something like that. It's possible. Yeah. With I'll call it the wave of stimulus coming through. And then behind that stimulus is going to be I think a little gap between inflation where your interest rates could fall a little bit to a more sustainable level, potentially. And we get like a double top. We call it the Batman pattern.
So the SPX going back all the way up here, right?
It could. I'm not saying it will. I'm just saying it could, because we've seen a decline in the 10-year treasury, the dollar's dropping, and that's usually a little, it's good for stocks for a short period of time. But it doesn't mean that that's going to be sustaining forever.
Look, there's a lot of There's a lot of sectors in the SPX that look good, eh? There's it's not doom and gloom. Those tech stocks, they did all the damage they could. If the tech stocks start bouncing up, a lot of good looking sectors in the SPX, a lot. So you're right, this could happen. But what I'm starting to look at is now adjusted for gold. What does the SPX look like? Because even if SPX does this, if gold and silver can outperform the SPX, it's like, who cares about the SPX? I'm gonna be making leverages on all the money flow, like you said, there the rates going down, the big money or the smart money. They'll say, okay, money's coming back in the market, it's fine. I'll sell my US dollars, I'll start buying stuff, but they'll be loading up more on the stuff that we own. They'll be loading up more on miners. They'll be loading up more on whatever, like all the stuff we've been early for. They'll be coming more into us than them. So while the crowd gets trapped and they say, oh, cool, SPX going up, and they put their money back in big cap stocks, what Facebook will actually be doing, they'll be doing bear market rallies. Look, they're gonna come up here. SPX, if Facebook goes all the way up here, SPX is probably going to be, you're right, it's probably going to be close to all-time highs. That could definitely happen. But gold has to outperform SPX on the next rally up, because if it doesn't, I'm scared. If gold cannot outperform SPX on the next rally up, and if silver cannot outperform gold on the next rally up, I'm going to be scared, because we could be back in some crazy 1995 type of thing where we suffer for another damn 6 years. I don't know why. And then there's a crazy melt up in the US equities, something like worse than 2001, something that we've never imagined before. So that's still on the cards. I still like I have that scenario in the back of my head. I think it's less than 2% possibility chance because of this chart. But it's really, we really got to listen closely to gold now. Gold is going to tell us if the next rally in US equities is commodity friendly. Because look, this chart, like this, as long as SPX versus PPI does not go above this line, I'm going to sleep well at night with all my commodity plays. If ever SPX is able to get above this line, I don't know where it's going to be this line because I need a like swing rally highs. If ever SPX can do that versus producer price index, we should probably bail out of everything we have. And we've miscalculated horribly the situation, Andy. We're really, it's that bad if SPX can outperform producer price index. Because look, when it did it here, it was game over for all commodities. Game over.
Yeah, no, I agree. I agree.
But look, when it's below, the wins on ourselves. Like, I don't see, look at it, you like fractals. Well, this fractal is the god same damn one that's happening right here. Same thing. Same thing.
Yeah. No. So I agree. I think that the producer price index is going to outperform the SPX. What I'm saying is we could see a bounce here because people think it's a perception versus a reality play. The reason I think that we've got a producer price index that's going to go higher is because we've got shortages or deficits in oil and metals. Like it will go higher, in my opinion. I am a firm believer in that based off of the imbalances in the system. The charts will show that, in my opinion. But we could see a bounce here because we saw a lower inflation number. The market thinks it's over. They don't know the deficits. They don't know what's out, ahead. They don't know that OPEC is necessarily out of spare capacity, which is going to blow up the inflation side. So I'm not anti-gold or anything like that. I'm actually very much pro it, but I think we could see a bounce in the S&P 500 just because we saw the 10-year yield drop, we saw the dollar drop. All these things are kind of dropping. I think we're going to see an everything rally, so to speak, where gold will outperform. I just think that the SPX will go up with it.
Okay, I totally agree. Yeah. People think it's one or the other. No, SPX and look, silver, especially since the 2000s, silver is a recovery metal, and gold to some extent also, because if there's a total deflation and debt disappears, well, gold's going to be naturally worth more, because if there's less, then increase its purchasing power. So it's on the recovery that you want silver to outperform FedEx, you want silver to outperform SPX, you want gold to outperform that. Then you know that we'll be making, because at the end of the day, we just want to be making more money than just buying the damn index, because I could have just bought the damn index and why complicate my life, So but in the 70s, I'll tell you, there's one case. So in the 70s, gold and silver move opposite of the SPX. They did not behave like a recovery metal like they have been since the 2000s, where, like you say, there's a recovery because of the yields and all that dropping, selling US dollar, and SPX goes up and gold and silver go up faster. But in the 70s, there's periods where silver and gold went up and SPX kept going down. They weren't getting dragged down. So I'm just wondering, like, what are the chances, Andy, we have that? Like, it's not happening so far, but is that possible?
I think we're going to have it. I think this is my guess. This is a guess. I'm just speculating here. I think that what we just went through is very similar to 2001, like 01, 02. We're going to see a rally come on up with kind of both. And then I think the next time it goes down, gold and silver keep going.
Yeah, man, that would be so I think crazy.
Yes, that's my guess. And the reason is because inflation is going to be ridiculous, and then people are going to start worrying about currencies.
And we did not have that in the 2000s as much, right?
No, not even close. Okay. The 2000s is totally different feel. Do you agree or disagree? I don't know.
Yes, definitely. It's like, because I'm too young, like I don't even know like how it was in the 70s. I have the charts to get a feeling, but it's like I want to have recency bias. I want to give more weight to the closer price action I have. Like, let's say everything's financialized and they have the same playbook as they did in the 2000s. But I cannot dismiss previous 40-year cycles, like that 10-year yield chart, it broke out of a 40-year. I have a whole bunch of charts. I think we went through this a few times. 40-year patterns are breaking out. So that brings us back 50s, 60s, 70s.
Yes.
So yeah, definitely. If ever there's a disconnect, we're gonna look like damn geniuses. Like I'm not calling that there's a total disconnect between gold where and silver where they go the opposite direction. But if it starts happening, it's gonna be pretty cool seeing that happen.
Well, I think we're not. I think we're like the 40s and 70s like combined.
Yeah.
40s from the time frame of how we broke out, like we're just breaking out of a big downtrend in yields, and then the 70s because of the energy crisis in the 70s is globally today.
Yeah.
So if you pair that up, and I don't think people understand the energy crisis yet. I think they still think it's solvable, that we'll just fix it, no big deal. We're just going to go get a bunch of these metals, everything's fine. What I think is going to happen is we don't have metals out there. They don't exist. Like we can't go to what they think they can go to in the size that they want to go. So the copper doesn't exist, the nickel, and just go on and on with whatever mineral you want, lithium, graphite, just whatever. Even we can start doing synthetic graphite, but you're going to run out of some sort of mineral somewhere to go to a renewable world. If you've got the pressure and energy, that is what caused the 70s. It was money in the system and the pressure of an energy constraint or metal, energy constraint in North America. Then what people worry about is the currency. They say, oh my gosh, we don't have the energy. Our currencies are predicated off of future growth, and we don't have the energy for future growth. What this all means that they're all overvalued. So the stocks dive because they're all short commodities and energy. And then the currencies are next because they say, wait, if a currency is a future promise to pay something in the future, but that promise to pay something in the future isn't coming. So they're going to say, oh crap, get rid of them.
Yeah, as
Then they
fast
all
as they
die.
can, right?
That's where
Yeah, yeah,
that's
yeah.
where you get the split of
Yeah.
commodities and precious metals versus the overall markets. That's my take on it.
Yeah, well, it's a very logical take, and it's like we've been like, especially like the okay, I can't say like the gold bugs or people who understand these basic concepts. They've been beaten because their timing was wrong, because they haven't noticed that SPX was outperforming PPI, but they had that mindset where, well, I don't understand, commodities have to be outperforming SPX. It's total like liquidity, like they're doing nonsense. That it's like the beaten wife syndrome. It's like they just they can't accept that it could go good in their favor one day. It's like people, even sometimes I'm there and I say, Jesus, man, it's like we were exploding in 2020, but it wasn't meant to be then. Now 2 years later, and it's like we have a difficulty accepting like good things could happen to the complex, which I think is pretty bullish to have that feeling. We don't feel invincible, right? We don't have a Michael Saylor with a flame torch saying leverage and sell, leverage your house and buy Bitcoins at 65,000. We don't have a guy doing that yet. We have guys like you and me, you telling like, this is cheap, I'm buying,
Yeah, that's what
I'm a little bit more conservative. Like I'm waiting for a little bit bigger breakout,
wait for the
but
break.
we're,
Yep.
we're still early. These are base. Like you saw these bottoms, these are 8-year patterns. Like these are, even now we have 2-year patterns across the board. It's like we're not topping by any means.
We
So
we just completed basing patterns in oil. Like we haven't even like started the up move,
I
in
know
my
the,
opinion.
the target at 300, we're gonna have to start taking profits. I think that's the next measured move there above 200 there. It's like until then, we're just, yeah, like you said, we're basing, but it could take time, and that erodes people's emotional capital that time, because they saw my targets or they see your targets, and then after that they think, oh, I'm going to buy oil now. But the market has a tendency to take its time more than we think, right? But I see that as a positive because most people were not like born millionaires. Just take your, not financial advice, guys, but no, with your cash flow, it gives you more time to prepare, because one day in the future, say, Jesus, if like people are gonna all rush in. Could you hear me? I think it might.
Yeah, I can hear you right now. It went in and out once, but
people are gonna rush in at the door. I think it's Sprott who said that there. It's like, I want to get in early before in that room, because when everybody rushes in, that's when we get these crazy reverse symmetry moves, right? That's when, let's say, oil closes above 150 or 60, I don't know when, and then everybody, oh man, I have to get in there. That's when it just it doubles. It's not time to buy when that happens. You have to be, yeah.
I've been riding it since 2020. Like I have not sold anything. It's just, I'm just riding it.
But because you don't need to sell, right? You're not looking for a fast profit.
No, I'm not.
That's
My
it. People have
strategy
to
is not
understand
that.
that. Yeah. Not so
My
because some
strat.
people don't understand that they people want a fast profit. They've been the millennials have been conditioned with cryptos. You just buy anything and I'm a millionaire. But this is the time to accumulate smartly. As stuff is breaking out, you could buy these companies, these dividend companies. You could start doing a whole bunch of stuff. But I'm like you there. I see the end game is in 8 years, 10 years. And the longer they drag it out for the bull run to start, the better it is for me because it's just going to be more violent and it's just going to last longer, the bull run.
Mm-hmm.
I'm in no
No, I
rush.
agree.
Like I know I'm 46. I understand people they're in their 60s. I know that, but it's like the timing's here. We can't force the market as much as our vision. We kind of see where we think the future is going to go. I can't force the market's hand, guys. It's like
Yeah.
there's
Well, it's all with the patterns and everything. All we're playing with is statistical probabilities.
yeah.
It's not for sure outcomes, and that's all you can do. That's the best that anyone can do is you get a cheap sector. You zero in on the cheap sector. You start looking at the charts. You sift through all the garbage, so to speak. You say, okay, these are the three best opportunities. I'll spread out a little bit amongst all these, depending on what your strategy is. If mine's to get the ultimate low price and cost average in, I call it sprinkling in a bottom. And then I hold on and wait for that time to have it go up. Another strategy is to not wait, be a lot more pinpoint, wait for the break to go to the upside and buy the breakout, which is another good strategy. It's different. It's just different strategies.
You could do
Mine
both.
takes longer. I mean, that one would be you'd get a quicker emotional hit, with that because it's going straight up. But I try to get the I don't know, the multiples, try buying at the bottom, because if you can catch a couple of bottoms, the rewards on the back end when it goes up, the multiples are so big that your risk reward is like 100 to 1 or 100 to whatever, or 300 to 1 or something like that.
Yeah.
But it takes a lot more time and a lot more emotional toil and patience to do that. So that's how I've been playing it. And I understand how that some people are not made for that.
But
So
yeah, but it's not that bad. Like stackers play like that because stackers,
yes.
they a little bit of their pay every week. I used to go with a
Yep.
guy at work and he showed me went to KidCon downtown Montreal. And I said, what is this? And every week he'd take his money, he'd go buy his gold coins, his silver coins, and he doesn't care. He's buying up, down. He doesn't even care. He wants ounces, you want shares, right?
Shares
And
and
it's,
ounces. I'm a stacker.
yeah,
I am.
yeah, accumulate that. So, yeah, you need physical, guys. Seriously, like even if I say it's not time to buy silver or gold, I own gold and silver also, like physical. Like
Mhm.
I'm not gonna mess with that. You still
Well,
need.
the problem with that is there is a point where if this is all leveraged up in the system, it could run out. I mean, it could be very difficult to get it at some point. I don't know when that point is, but it could get very difficult.
So yeah, make sure you have some though.
Mm-hmm. Mm-hmm. Yeah. Do you have anything else to share, Patrick?
No, it was fun there. We didn't touch on the cryptos, but
Yep.
where the SPX goes, they're probably gonna get a bounce, and that's something curious people could look at. Is if SPX is going up and cryptos is not going up, that's a warning sign because the next time SPX goes down, it could get really ugly in crypto land. If cryptos start
Mm-hmm.
really outperforming SPX, or NDX, Nasdaq, that's positive because cryptos have broken down versus Nasdaq for crying out loud. So if you can't even outperform the tech stocks, why even bother with cryptos? Might as well stay with the Nasdaq. And silver and yeah, Bitcoin has broken down versus gold versus silver. Silver, man. Bitcoin broke down versus silver. It's like nobody loves silver. Silver went from 26 to 20, and it still outperformed Bitcoin in the past year. Michael
Yeah.
Saylor's not talking about that. Max Kaiser, I'm naming names. They're not mentioning that silver preserved your purchasing power better than Bitcoin the last year.
Yeah. I
it's
know.
it's
I agree.
crazy. It looks
Yeah.
super bullish for silver. You look at the silver Bitcoin divided by silver, you say, Jesus, man, I want to be long silver.
Yeah. I don't know what necessarily did worse than Bitcoin or maybe some of these crypto
Yeah.
coins. I mean, they really got smoked in a tightening monetary condition. you know, out in the markets, they got really hit. So you have anything else to share?
No, that's it. Sugar, guys, sugar, the chart's looking great. I posted something this week there. I'm waiting for the breakout, but it's finally after. You see, that's what's long because it exploded. Sugar, I spotted a while back. It exploded. It's been consolidating for like a year and a half, almost 2 years. It's like it's tough, but the next opportunity now in sugar and the gold and silver miners. I overlaid the gold and silver miners chart to sugar. It's practically the same. So if you think there's manipulation in gold and silver, well, maybe there's manipulation in sugar also, because those charts, they're the same. I have no explanation other than capital flows. They leave growth and they go towards commodities and hard stuff. And it's just like cycles that repeat over and over. It's like, I don't know. You've noticed this, like charts, they all look alike in the commodity complex. Like some look more like oil because they're energy driven. Some look more like the metals because for whatever. But it's either you look like those type of charts or you look like a growth tech stock. You know, it's like one or the other. So
yeah, I agree. It's all financialized.
Like, it's all financialized. It's like the perfect word. I think you coined that. It's all financialized. Yeah. So it's money goes one place or the other. And I think the game changer, the needle that decides where the railway goes, it's inflation. Actually, it's a SPX breaking down versus inflation. That is for me, that's what's guiding my whole mindset and my establishment of probabilities that were correct for the next 10 years for the gold and all that stuff there, name it, uranium, copper, blah, 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 everything, like, you know, all that stuff should do great there.
I agree. I'm totally agree with it.
We have to disagree. We kind of slightly disagreed at the beginning on our techniques, but we weren't disagreeing because it's just two different models of investing or trading.
It's the strategy that you deploy, but you use whatever strategy works for you. I mean, that's really what you want. And some people can't ride through the volatility, so they have to find a strategy where you buy it, you kind of scale out, take profits, you buy the next one, scale out. But
yeah, that's the best advice, Andy. Everybody has to find a trading framework that fits their emotional profile. They have to, or else if it doesn't fit in your emotional profile, you'll just be, you know, it's like, are you timid? Are you gun shy? Are you the aggressive guy who at the bar hitting all the girls? You have to figure that stuff out right before. Right.
So are you the guy hitting all the girls at the bar? Is that what you're saying?
Those days are long gone. I don't even know the last time I went to a bar like that. You know, like I can't even remember the last time.
Yeah, I don't go to bars really either.
Family restaurant, and that's pretty much.
Here's one way to tell what kind of person or personality trait that you have a little bit. When you get money, do you want to go and buy something with it? Like an investment mentality is you get money and you want to deploy that money. A trader type mentality is when you don't want to put anything in any of the markets, you're scared for everything. And then you just kind of want to get in, but then you're scared when you're in it. Like, it's almost like you want to get back out. Like, that's a trader mentality. It's like, I'm in, I got to get out. And then investors like the opposite. It's like, I got cash, I got to get rid of this. Like, go get me something, like some investment. That's kind of how I have always viewed it. I'm the investment type. I want money to come in and I want to go buy something with it and get invested and try to look for an opportunity and deploy money. That's just the way I work. So, yep. But that's all I've got, Patrick. I don't know if you had anything else.
No, that's great. It's good stuff, man. Hopefully, folks enjoy this conversation we have again. People seem to like our conversations, Andy. I don't know why, but we seem
if they want to come out and if they want to reach out to you, they reach out to you at it's at Bad Charts 1, right?
Yeah, that's it. All the stuff's there, guys. All the free stuff. I have a website there, Northstarbadcharts.com, but just start with Twitter and have fun there.
Yep. All right, guys. Well, that's all I've got. We'll catch you later. This is Finding Value and Patrick. Oh, nice guns. See ya.